Yesterday, the Reserve Bank held interest rates steady. This was widely expected because last week inflation came in a little bit under what the market had expected and broadly in line with what we and the Reserve Bank had been expecting. Indeed, our inflation forecasts are very similar to the forecasts for inflation that the Reserve Bank released yesterday in their statement on monetary policy. But we'd been thinking that the Reserve Bank would see its way clear to start cutting rates towards the end of the year. At her press conference after the Reserve Bank board meeting, though, Reserve Bank Governor Michelle Bullock all but ruled out a rate cut this year. What accounts for the difference? At Westpac, we've long understood that monetary policy operates with a lag. And that means that when policy is tight, you do have to start withdrawing some of the restrictive stance of policy ahead of inflation actually reaching target. The Reserve Bank understands this too, but it has less confidence that inflation will actually follow in line with its forecasts. There are a couple of reasons for this. One is they're quite optimistic about global growth. Their forecasts were finalised ahead of the release of weaker US labour force data over the weekend. And while they won't be reacting to that weaker news anywhere near as much as financial markets did over the weekend, that kind of information would suggest that perhaps they're a little bit optimistic on global growth relative to some other observers. They've also recently upgraded their population growth forecasts. Australia has had a surge in population growth after the borders reopened following the pandemic, and we had already penciled in that population growth would be about 2% over 2024. The Reserve Bank had a lower forecast until recently and have since upgraded to something closer to where we were. In the end, though, the difference in view, with the Reserve Bank Governor all but ruling out rate cuts this year, comes down to the level of conviction about inflation. While our base cases are the same, the Reserve Bank is worried that inflation is not coming down fast enough. It has a lot of weight on its views of aggregate demand and aggregate supply, both measures that are quite hard to wrap your arms around. And they're a little bit more pessimistic about productivity growth than we at Westpac Economics are. There will always be differences of views about the future, but right now our earlier view that rate cuts could start in November doesn't look to be achievable. We'll be reassessing our view of inflation pressures, as will the Reserve Bank, as new data come in. Because while our central case is the same, there are clearly different views of the risks, and we will need to see more data to assess exactly which way the Reserve Bank is going to jump.
The content of this recording is informational and of general nature only and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.